All right. Good morning, everybody. So the whiplash continues, another day up, another day down. The energy crisis continues. We have both parties who seem to be talking past the other side. U.S. administration says talks are going good, the war is over, everything's great, while they continue to put military assets into country and look like they are building up troop movements. The other side says they're not talking to anybody. There has been no talks, and their concessions are steep, to say the least. We're going to get job numbers today. These aren't the non-farm payroll job numbers, but any job numbers you want to pay particular attention to. It goes to the Fed's dual mandate. We are right around the world. Hong Kong down 0.5%. Germany, Europe around 1.25 to the downside. Japan at 1% negative. So kind of spread out. The number on the initial job list claims, it's almost like it's broken. It just seems like we're not seeing this number change much from one session to the next. But therein lies the risk. If we do get an outlier, the markets are likely to respond to that. The thing is, we're not expecting any outliers. The risk with markets is the unknown, right? Even if it's bad news, as long as the market knows that bad news is coming, then even bad news isn't really all that damaging with the market. Surprises is what gets the market. So watch the numbers today at 8:30. We're not expecting any surprises, which would cause volatility and violence if we were surprised. Outside of that, for big ticket items, that's the only thing on the table today. Tonight, we've got Fed speakers chipping their teeth, but that's after the 4:30 bell rings. We got auctions today. They're still pretty close to the front end. We're not digging into the deeper ones. Still want to pay particular attention to those. And the earlier auctions, you could probably just use IRX. And we've got Bank of England and other Fed speakers just out doing their normal chit chat. We are going to get some gas data today. It's typically this way. We get crude on Wednesday and gas on Thursday. Keep your eye on that. Remember, energy is the crisis right now. It's one of the biggest issues when it comes to goods, inflation, shipping, everything, right? Everything is looking to increase if energy costs go up and stay up. We can see CTA positioning. The rate of change continues to steepen. So their portfolios are below the zero line now, and it is accelerating. But if you look at the VC funds, this is volatility control funds, they're still holding out. So we haven't had the sort of VIX shock and awe that would cause this to change yet. Now, I was listening with Bloomberg this morning, and the administration is preparing for various scenarios. One of those scenarios listed was crude over $200, or maybe it was 250. It was a very large number. And as you can imagine, if we hit 200 or 250 in crude, then that very likely is going to trigger the VC funds. Is this going to trigger the VIX? And we might actually begin to see the VC funds change their positioning. But for right now, same old from that direction. They are non-discretionary funds, right? They don't perform analysis and uh, run trades on their gut. They have a strict set of rules predicated on the VIX, and when the VIX is above certain levels, they have to sell X amount, and when it's below certain levels, they have to buy a certain amount. They don't get to choose. So since the VIX hasn't triggered into those levels, we continue to see them not selling off yet. Risk coming out of the White House is around moderate, 25%. This can, of course, change through the day if they run anything impromptu. So, if he's walking to the chopper and they start asking him questions or anything like that, right? Any additional risk could come along just from any reporter's ability to lob a question at him and get a response. Oh, what could go wrong, huh? Fannie Mae to accept crypto-backed mortgages for the first time, according to the Wall Street Journal. Why not? It does look like things are coming to the head soon, one way or another. Um, this, of course, could turn into a long, drawn out conflict, but there are indications that it's looking to be wrapped up soon. One of the items cited for this getting wrapped up is the president meeting with China. The meeting that was scheduled had been canceled due to the situation in the Middle East, and uh, a new meeting has been scheduled for April or May, which puts a kind of a deadline on this situation since he wasn't willing to have the meeting as long as this situation was happening. Now there's a meeting on the books scheduled, implying that maybe this will be over and that meeting could take place. That's not a lot of certainty, right? But it is another thing being tossed out there as one of the indications that all of this is likely to be wrapped up soon. There's a whole lot of unknown in all of it, so I would tread lightly and don't think that the general public has a real good idea of what's happening militarily behind the scenes. Remember, chaos and confusion is deliberate, so they will misdirect, misguide, and we just don't know, right? We are not privy to what's happening Overnight volume 112,000, so they are participating. And that feels light compared to what we've seen recently, but it's still above the average, with the average sitting around 50 to 55,000. So still double the average. We are hanging out above the put wall, still underneath zero gamma and the volatility trigger. As we remain in a negative gamma environment, we anticipate dealer positioning to exacerbate the move. So if we go down, they sell into it. If we go up, they buy into it. If you're not used to this dichotomy, the way things generally work is when we're above the zero gamma and the volatility trigger, if we attempt breakouts to go higher, they would sell into that breakout. They sell into strength, they buy into weakness. They go against the move because they're working to keep their portfolio in a delta neutral state, right? These dealers don't have a dog in this hunt. They don't care if the market goes up or down. They are making book for us, anybody who wants to trade, and that leaves them holding a bunch of stuff, and they need to get risk out. That's all they're trying to do, is keep that portfolio as delta neutral as possible. So in a positive gamma environment, when we break out and run, they're selling into it to keep that portfolio in a balanced neutral gamma complex. But we're not in positive gamma, we're in negative gamma. So now they have to do the opposite of what they would normally do to achieve that same zero gamma balance. The takeaway is if we start to break down, it could become very violent and we could break down swiftly because they will be selling into that selling and add to the fall. If we was to break out on the week, it could be just a breakout of yesterday's level, but really I got this sneaky suspicion we're going to need to get a little further than that because the zero gamma is above there anyways. So I'll put Monday's high, which is the 10-week, as that breakout point. We get above that and we're likely to have a move that looks a lot like Monday, but we'd have to get above Monday to see that sort of violence. It wouldn't really look that bad, but you get the idea. It'd be a lot of buying, and it's likely to be violent and forced, more than just a grind high sort of behavior. But we're a long ways from Monday's high, a long way from that 10-week, and there's a lot of things between us and that 10-week that we would have to work through just to get there, and then have the fuel left after that to go even higher. It's not likely that we'll see that sort of behavior unless we get some really amazing headlines. And those would have to be some very positive headlines. So the bigger risk and the more likely direction at the moment is down. That we either A, hold the line, stay within Monday's candle, or B, we break Tuesday's low and we begin the expansion to the downside to close this liquidity gap 65.20 or 65.11, whatever it is down here where we opened on that big bar, then cutting through the low of the week and beginning an expansion to the downside. 64.50 is what's on my radar since I'm still a firm believer that we're running 50s. 64.50 first, then we would reevaluate at that point, see what's below 6400 and then 63.50, level by level, right? For right now, it's a nada. We got to get through this range that we've been in and get going. We have reached the ADR, and we did it pretty early in the day. All things considered, if you reach one side early enough in the day, you can go to the other side by the end of the day. That would not be considered bullish. It's just the way price moves. Right? Here's a really generic example of that, but it proves the point, right? This slope was headed to the upside, that slope headed to the downside. Price just moves in a wave. It's what it does. So if we made the wave on the lower edge, then we would have the expectation that we make the wave on the other edge. There's a historical precedent to this. I've been using these ADR lines for years. I built my own, and ADR stands for average daily range. I use a 21-day average range. 21 days is a market month. What this indicator is doing is looking back at a daily chart and asking, hey, on a day-to-day basis, what's the average movement that this particular product does, right? Because we can put it on anything. It doesn't have to be the ES. So what's the average movement from the highest point of the day to the lowest point of the day, and the distance between the high and the low? Looking back over a 21-day period, how far does this market typically move on a day-to-day basis? And consistency is a really big deal, right? So if the ES has an average move of 124 points, from where we open in Globex, we split that in half because of the wave. Markets, they go up and they go down. So between these two red lines is 125 points because that's the average daily range. And that's if we don't have a bias and we're not bullish or bearish. If we get bullish, we can go to that yellow line. From where we open in the Globex all the way to that yellow line, it's 125 points. Or we could get bearish. From where we open in Globex, we can go down to this yellow line. That's 125 points. We want to look at what a market normally does so that we have an idea of what normal looks like, and we can anticipate what's going to happen today if price continues to behave normally. Now that we've reached the edge early enough, we can go to the other edge by the end of the day. If we break this ADR half and we get underneath it, it opens the door for a continuation down to the other ADR line. Once we're underneath this level, it's more likely that we go to that line and not this line. If we get down here and we get back up, once we're back above that level, it's more likely that we go to that line and not as likely that we go to that line. That's the way it works, right? So for now, we're still above that line. The expectation is we're going to go to the other side. Now we can wick down below it. That's not enough for us to aim for the downside here. Just wicking down, dropping through. We're looking to get completely below it and have no expectation of a rise back up. We can see earlier in the week, Tuesday's RTH low here. So we could overshoot that ADR and get into the low of Tuesday and then turn around and come back in. It's absolutely possible. So it's not a game of pennies. We don't mark things out to the tick and expect a reversal there. Today's floor pivot is higher than yesterday. That's bullish. Price opened underneath it. That's bearish. We are below the weekly pivot. That's also bearish. We tested that weekly pivot multiple times last night. We wasn't able to get above it and keep it. We don't have an MDP because we've already hit that pivot this morning. But we barely hit it, right? We just kind of wicked it. ATR means average true range, Tom, which is different than ADR, right? Average true range uses a in my opinion, overly complicated system to divine what average range is. And hit me up later. I'll send you a really good article from stockcharts.com who goes into, I think, really good detail on explaining what the ATR is. And after you read that, probably come up to the same conclusion that I did, that it's convoluted and overly complicated for no reason whatsoever. And I would rather use something that is more simplistic, easier to understand, easier to calculate, because since I wanted to make my own. And that's why I like the ADR rather than the ATR. If we're going to make a move back up, we're going to have to get through that weekly pivot. Just to get to that weekly pivot, we're going to need to get back inside that channel. Since we've already hit the daily pivot, we no longer have that MDP, but look, we just wicked it. I mean, just any structure that's there, it's still there. We haven't taken anything away from it. So be mindful that a move to the upside is going to have to deal with that level. Because of yesterday's tight range, the S&R lines for today are going to be very narrow. As you can see, we're already underneath S1 and we are approaching S2. Typically, we would look for something like an S1 R2. Now that we're already through S1 and moving into S2, we have a lot of work cut out for us if we want to try to make the move back up. We would first have to cut back through the S1, which is a cog line, 6611 cog, then back inside of the RTH of yesterday, up to the weekly pivot, through the daily pivot, out the other side of the channel, all the way up into R1, and then yesterday's RTH high. Just so many things in the way of that run. Now we can do it, especially with a headline, some kind of shock and awe like Monday, where we just took off like a bottle rocket. We can get that sort of behavior, but that kind of move isn't sustainable. Most of the time, we just unwind it anyways. And two, what's going to bring that fire? The market fell for that headline on Monday, and then, since then, we've seen the same sort of announcement or proclamation again and again. The war is over. We've already won. We're awesome, right? And the market just isn't falling for it anymore. So it's going to need to be a new headline, something that hasn't been rewritten so that the algos will fall for it and get another spike to the upside. If we break S2, we have S3 at 6511 cog line, way down yonder. We're continuing the work that we put in last week. We got this distribution here. If we had just maybe another day, we could have brought that point of control down, but of course we didn't, right? The week ended, and then we've been building it out this week. So we've got a lot of structure here that we've put into place. The concern is that we're going to leave this structure behind. We're already out of the value area. Now that we're out of that value area, we have the low end of this structure, which is Tuesday's low, and then it gets really thin, and we can move through thin areas swiftly. That would get us down below 6,500, down into 6,480, and then down we go, right? 6,450, 6,400, 6,350. Because we're running 50s, yeah? We are out of moving averages on the daily. We are at the 50 week, and there is no more moving averages underneath the 50-week until we get below 54, not 64, 54.50. It's a long ways off you. That's untenable. We won't get that kind of drama. It would break things. We've got lock limits on the futures, just like there's lock limits on everything else. And we haven't triggered those kind of lock limits since COVID. Mostly on the way back up, we were triggering lock limits, right? Which is why they petitioned to remove the lock limits in the last 30 minutes of the day so that the institutions could come in and buy the futures hand over fist and skyrocket it to the upside without triggering lock limits. Must be nice to just turn off all risk controls, right? Run it till it breaks. You can see on the weekly while we're here, this tail risk, wick risk, whatever they call this. This is a pattern. I can't remember the name of it, but it's worth noticing. Lower highs, lower lows, large wick structure on the upper end, and continued lower closes. Even so far this week, with this candle being hollow, I use trend candles. So this candle is red, but it's a hollow red. That means at the moment, the current close is lower than the previous close, but the current close is higher than the open. If the close was lower than the open, then it would be a filled in candle. So it won't stay red if we get above this previous week's close. But looking at that wick that's already on there, if we continue to fade back down and we can get through this open, then it'll be a filled in candle. We'll be below the 50 and we'll continue that expansion to the downside. Ten-day, 30-minute volume profile and TPO. The TPO looks pretty good. We've got a decent value area on both sides. Point of controls are lined up. We're leaving the value area. We get below Tuesday's low and it gets thinned out, puts us down into Monday's low, and then it's game on. We'll have to stretch the entire thing lower. The VPOC that we marked out on Tuesday has been taken out. Now, in theory, we should leave this on all day. I don't need to. It's already really close to one of my cog lines, so I'm just going to go ahead and take it off. But since we haven't interacted with that area on the intraday through the after 9:30, you could leave it on there with the idea that we might try to make a move to the upside once we're in the regular trading session. And on that move up, we would want to be looking for what could we hit? And that would be a level that we could hit, that we could have an interaction with. We have a new VPOC, which is from Wednesday. I should have just took that line and carried it up, but whatever. We'll just take that one. So I don't zoom in and get it to the tick perfect. I get it point close. It's close enough. If we get through our own Globex high and try to make a run for it, we've got the VPOC of yesterday to deal with. Through that, we can then deal with yesterday's high, and then we'll deal with Monday's high, level by level. There's nothing down here, guys. We break Tuesday's low. I mean, look how there's just nothing there. We won't start running into any structure until we get down to that 65.50. We're still hanging out within the week's range. Everything is fine from that point. 64.32 cog line is the low edge of this week's range. That's not bad. We're not there, right? So we've got plenty of room. 6,500, and then a break below that, 64.92, then Monday's low, and then 64.50 and 64.32 cog. Level by level by level. We just run it until it breaks. 1.3% below the 10-day. We got that imaginary collar around the 10-day moving average. A 0.5% above and below, and 1% above and below. And you can see, as you can imagine, we're outside of that. We're not into the risk area though, right? If you think of zero as the center of the basketball court, then we've got a lot of room to run. If we did want to go in the other direction, we could retrace 1.3 and then get above zero and make another 1 to 1.5 before we start to get into risk areas. So for an upside move, we got plenty of room. To the downside though, we don't have as much. From 1.3, we could get into 2, maybe 2.3, and then we have risk of dropping off. Flash crashes and extreme selling happens from oversold levels. That's the way it goes, right? So if we get to -2 or -2.3, and then something triggers us lower from there, that's where we could get flash crashes and extreme moves lower. So keep your eye on how far away we are from the 10-day moving average. You can just use drawing tools, right? Even the simple one, this one. Until you close the line, it is calculating distance and percent. You can see it in that box. Now, once I close the line, the box is going to disappear, and then I would have to open the settings and turn the box on if I want the box to reappear. But as long as you don't close the line, you don't even need to turn that on, right? You can just measure it and see the distance. So keep your eye on how far we get from the 10-day today if this selling persists. Because 2 or 2.3 is just about as far as we want to go. Anything more than that, and it risks getting ugly. Like coyote ugly. Gold miners and junior miners are down this morning. The Mag 7 up volume is down. China's internet ETF KWEB also down. And they're all down heavily, right? We're talking -3% to the downside. Bitcoin down more than 2.25. Uranium 2% to the downside. Emerging markets, metals and mining, China again. Jets, airlines, general technology, software and services, quantum, banks, bonds, communications, building materials, industrials, everything. Everything is down this morning. So yesterday, we had that really positive market breath. We talked about it quite a bit, and it just did not get us where we wanted to go, right? It was blocked the whole time. VIX and crude just wouldn't release that stranglehold, and we never got that really beautiful run that we could have had. Well, now we've got a very strong market breadth again this morning, but this time it's really strong negative market breadth. Looking at what's up this morning, what's nothing. That's a short list. Energy is up, XLE and XOP. It's generic. XLE is, but it is up. That's all we've got. %52 of the NASDAQ is down at least 0.5%. 54% of the S&P is down at least 0.5%. These don't really get a lot of love, but these heat maps are really nice when you get used to them. I remember when I started, I seen these heat maps and I thought, this is so stupid. Who would even waste their time? Why did you even build something like this? It's so silly. But I got to say, after squinting at watch lists for a couple of years, you get to kind of appreciate these simpler, easier to read. At a glance, you can see what's going on. All right. So the color scheme is pretty simple. It's running at about 0.5%. If it's down 0.5% or more, it's red. If it's up 0.5% or more, it's green. And if it's not, if it's in the middle of those 0.5%, then it's gray. The size of the box is the market cap, so you can see the Mag 7 easily. It's these big boxes. And so at a glance, you can see what's going on out there. All the Mag 7, except Apple, are getting beat down. And then, of course, you can break it down into groups easily enough. You can divide by sectors or not. You can change if you don't want to sort it by market cap, you can sort it by something else. I like market cap, so it just makes it easy to see. So we got nothing out there. There isn't even one industry or sector that's getting some love today, right? Like staples or something like that. Nope. Now we could have sussed it out here, right? We can get to the same conclusion by squinting at all of this, but gotta appreciate it a little bit, right? So it's simple enough, guys, as it always is. Start with the basics. You gotta get out of the box. The box for us this morning is our Globex range, as usual. Break the Globex range to the upside, we can challenge yesterday's high and then the ADR on the upside, which is my base case as long as we're holding above this lower ADR red line. Because we've reached one edge early enough in the day, we can get to the other side by the end of the day. I say early enough, but the day's half done, more than half done. It might not feel that way to you, sleepyhead. You slept through half of it. But the market opened last night at 6 p.m. We are past 6 a.m. this morning. The day is more than half done. But we got to the ADR before the bell rang at 9:30, and that gives us the time that we need to get to the other side by the end of the day. So, a little bit of a TRB setup, get back above VWAP, cross through the cog line 6611, challenge the midpoint of this Globex range, get to Globex high, get to yesterday's high, and then get to the upper ADR. Nothing to it, right? If we do get to the downside, I've laid those levels out multiple times. The ADR full, 6,500, 6,450, 6,400. Level by level, down we go. All we got to do, get out of the box. So what I got for you guys, be careful, be safe. Watch the clock today. I'll see y'all tomorrow.
Record.